Over the last couple of weeks, Europe's gas buffer has been shrinking again, and the market is reminding you what really sets the price in winter. Storage started draining faster, and benchmark Dutch TTF moved up with it, with reporting putting the front month around 42.60 per megawatt hour in late January. Here's the promise. By the end of this video, you will know what Europe's storage level is actually telling you, what the futures curve is screaming or refusing to scream, and the 3 simple markers that confirm whether this is a temporary weather story or the start of a real pricing regime shift. Start with the receipt. Gas infrastructure. Europe's storage dashboard is the daily reality check. It is not a model, it is a count of what is in the caverns. It shows percent full in energy and storage, country by country. If you are trying to understand risk, that is the first screen. Now the second receipt. Financial Times reporting tied the storage drawdown to a seasonal low not seen since 2022, and it cited TTF around 42.60 per megawatt hour. Reuters analysis made the same point in different language, saying, storage is draining, but pricing has not yet taken on the urgent shape markets remember from 2022. In plain terms, Europe is using up its cushion faster than normal. To make this real, keep one anchor in your head. Imagine a mid-sized German chemicals plant that runs on gas as an input cost. When prompt gas prices jump, margins compress. When the forward curve signals higher, refill costs into summer. It stops being a winter headache. It becomes a year-long tax on industry. So what actually happened? The story is a sequence. First, storage entered the year at a weaker starting point. That matters because storage is your shock absorber. High inventories turn a cold week into a small bump. Lower inventories turn the same cold week into a bigger move, and the move feeds itself as buyers rush to lock in supply. Second, prices responded, but not in a pure panic shape. In 2022, the curve screamed backwardation. That is the curve telling you gas today is far more valuable than gas later, because the system cannot easily refill. This time, the curve has been more mixed. That is why the Reuters no urgency framing matters. It is not saying there is no risk. It is saying the curve is not yet confirming a true shortage narrative. Third, the policy backdrop is still tightening. The EU Council approved a stepwise ban path in late January 2026, aiming to end Russian LNG by the end of 2026 and pipeline gas by late 2027, with limited flexibility tied to storage filling. That is not today's weather, but it changes the medium-term supply map. Put simply, Europe is trying to refill a bathtub while turning off one of the old taps. Now, the mechanism chain without the jargon. Gas pricing in Europe is set at the margin. The price is determined by the last unit of supply needed to balance the system. When storage is high, that last unit can be a cheap withdrawal. When storage is low, that last unit is more likely to be imported LNG or pipeline supply that competes globally. That last unit is rarely cheap. In plain terms, low storage makes Europe pay world price more often. There are 2 ways this becomes a macro story. One path is inflation sensitivity. Higher gas prices feed power prices. Power prices feed headline inflation and inflation expectations. If that shows up in euro inflation pricing, rates react because the cuts are easy story gets less clean. The second path is growth. Higher energy costs hit industry first, then households. That German chemicals plant is the canary. If gas becomes a structural input cost problem, output gets cut, investment slows, and credit risk starts to feel it. So, what did markets do around this? In commodities, TTF moved higher, with reporting putting it in the low 40s per megawatt hour in late January. In equities, the reaction is often muted at first because the burden is uneven. Utilities and energy-intensive names feel it before the broad index. In FX, the euro's response depends on whether the move reads as imported inflation or growth tax. Here is a common misread that always shows up. People say storage always falls in winter, so this is noise. The missing piece is the starting point and the slope. A normal drawdown from a strong starting point is noise. A faster drawdown from a weaker starting point is a change in the buffer. And here's the second misread. People say LNG supply is expanding, so prices cannot spike. LNG supply matters, but the market price is timing and logistics. You can have a bullish long-run supply story and still have a tight prompt market if arrivals do not line up with cold weeks and storage needs. Put simply, plenty in theory does not help this week. The hinge concept in this whole story is the futures curve. If the front month pops but summer does not follow much, that is the market saying the system expects to refill later. If the whole strip lifts, especially summer and next winter, that is the market saying refill is going to be expensive. That is when industry and policy start to sweat, because high refill prices mean you carry the pain forward. Bring back the German plant. If prompt prices pop for 2 weeks, it grinds through it and hedges some. If the summer curve lifts, procurement either locks in higher costs for months or runs the risk of being caught short later. That changes behavior, and behavior is what makes a story persistent. Over the next 24 to 72 hours, the first question is simple. Does storage keep sliding fast, and does the prompt price stay sticky, or does it mean revert as weather normalizes? Over the next 2 to 6 weeks, the question becomes refill math. Do summer prices rise enough to pull LNG cargoes into Europe, and do policymakers start talking about security of supply again? If this persists into spring, it becomes a structural story. Lower storage at the end of winter plus higher refill costs is the setup for a fragile next winter. And that is when the curve starts to price tail risk, even if nothing is broken yet. Now, let's tighten the story down to what actually confirms risk, because storage headlines alone can fake you out. The first confirmation is the storage path itself, not the level on one day, but the change over several days. Gas Infrastructure Europe's storage dashboard updates daily, and you can track the percent full and the energy in storage. If withdrawals keep running hotter than the seasonal norm for a full week, that's your first real signal that the buffer is shrinking faster than expected. Plain English, if the tank is draining faster than usual, you have less cushion for surprises. The second confirmation is the curve shape. This is the part most people skip. If the front month price is up, but the summer contracts barely move, the market is saying we can refill later. If summer and next winter rise with the prompt month, the market is saying refilling will be expensive, and the risk is not just this cold snap. In plain English, a 1-month pop is a bruise, a whole curve lift is a limp. The third confirmation is LNG flow behavior. You do not need secret data, you need observable outcomes. Are LNG cargo arrivals and send-out rates rising into Europe when prices rise? If arrivals increase and the curve relaxes, tightness is being solved by supply. If arrivals do not respond or respond too slowly, the market tends to keep a risk premium. Here's what changes for our anchor example. That German chemicals plant. In the first block, the risk was margins getting squeezed by a prompt spike. Now the new consequence is hedging cost and planning. If the forward curve lifts into summer, the plant's finance team starts locking in higher input costs for months. That pushes product pricing up or forces production cuts. Either way, it becomes visible in industrial output and earnings guidance, not just in the gas chart. A quick receipt moment again, because this matters. Financial Times reporting cited the benchmark TTF around $42.60 per megawatt hour and flagged storage at the lowest seasonal level since 2022. Reuters framed it as storage draining, while pricing still lacks the 2022 style urgency. Those two lines together tell you the state of play. The buffer is thinner, but the market is not fully shouting scarcity. Now, why is urgency even the right word? Because the curve is the market's lie detector. In a true shortage, the system wants gas now, no matter the cost. That is backwardation. It punishes anyone trying to wait, and it rewards bringing supply forward immediately. In plain English, if the curve pays you to deliver now, the system is stressed. So why might the curve stay calmer even when storage is lower? One reason is expected LNG supply flexibility. Reuters' analysis has pointed to a broader outlook where LNG capacity expands over 2026. That can cap long-run panic, even while the prompt market moves with weather. Another reason is demand response. Europe's industry and households have already adapted since 2022. Efficiency has improved, and some energy-intensive production never fully returned. That reduces the chance of runaway demand spikes. In plain English, the system learned to use less when it has to. But those are not guarantees. They are just reasons urgency might be muted early. Now bring in the policy layer, because this is where the medium-term risk gets teeth. The EU Council approved a stepwise plan in late January 2026 that targets ending Russian LNG by the end of 2026 and pipeline gas by late 2027, with limited flexibility tied to storage filling. That is not a weather forecast. It is a supply map change. If Europe is serious about that timeline, the replacement supply has to be contracted, shipped, and priced. In plain English, Europe is swapping a known supplier for a competitive global market. If you want to know where this shows up first, it is not in a dramatic headline. It shows up in term pricing and procurement. That is our pressure point. The first thing that breaks is not lights out. The first thing that breaks is confidence in the refill path. If the market believes refilling storage will be expensive or uncertain, the curve lifts, hedging costs rise, and companies behave defensively. Now the stakes ladder tied to real time. Over the next 24 to 72 hours, the story is mostly weather and flows. A cold surprise can pull down storage faster and keep prompt prices sticky. If weather normalizes and arrivals pick up, the move can fade quickly. Over the next 2 to 6 weeks, the story becomes refill math. The market starts caring about how much is left after winter and what it costs to rebuild inventories before next season. If this persists into spring, it becomes a structural pricing story. Low end of winter storage plus high summer prices can create a fragile setup for the next winter, even without any new shock. Now, let's lock the 3 markers into your head, cleanly, so you can track this without guessing. First, check gas infrastructure Europe storage every day. Watch whether the drawdown rate stays elevated for a full week, not just a day. The lag is basically 1 day, because the dashboard updates daily. Second, watch the TTF curve, not just the front month. If summer and next winter lift with the prompt contract, refill stress is rising. This is same-day information, because futures move in real time. Third, watch LNG arrivals and send out into Europe. If higher prices pull more cargoes and the curve relaxes, the system is solving the problem. If arrivals do not respond, risk premium tends to stick. The lag here is a few days to a week because shipping and scheduling are not instant. Bring back the German plant one more time for this block. If those 3 markers flash red together, that plant does not just pay more next week. It starts planning for higher costs all year. And that is when the macro story becomes visible in growth, earnings, and credit. Now let's close this out by connecting the dots to the rest of the market, and by spelling out what would make this story fade versus escalate. Start with rates. Energy is one of the fastest ways the real economy talks to inflation expectations. If gas stays elevated and power prices follow, it can show up in European inflation prints and in market pricing for inflation compensation. That matters because it changes how easy central bank cuts look. Not because one gas move forces a policy pivot, but because it shifts the balance of risks. Plain English. If energy stays pricey, cuts are obvious, gets less obvious. Now, FX. The euro's sensitivity here is asymmetric. If higher gas prices are seen mainly as imported inflation, the euro can sometimes hold up because nominal rates feel supported. If higher gas prices are seen as a growth tax that hits Europe harder than the US, the euro can weaken. The key is whether the move feels like a temporary spike or a persistent drag. Plain English. A quick spike is tolerable. A long tax hurts the currency. Now, credit. Credit does not usually explode on day 1 of an energy story. It shows up in margins, then in guidance, then in spreads. Watch for the sectors that live close to the energy input line: chemicals, metals, paper, and parts of industrials. If the curve lifts and hedging costs rise, that is when financing conversations get tense, because future cash flows get repriced. Plain English. When costs lock in higher, lenders notice. Now, equities and vol. Broad indices can look fine, while energy risk is quietly migrating. What you tend to see first is dispersion. Some companies can pass costs through, others cannot. That dispersion can lift volatility, even if the index level looks calm. If rates also drift higher, duration-heavy equities become more sensitive. Plain English. The index can stay calm while the inside breaks. So, what makes this fade? The fade scenario is simple. Storage withdrawals normalize because weather moderates. LNG arrivals respond to higher prices, and the futures curve stays relatively contained. In that world, you get a winter bump, but refill confidence remains intact. The market stops paying a big premium for immediate supply. And the escalation scenario. Escalation is when the system loses confidence in refill. Storage continues to drain faster than normal for multiple weeks. The summer and next winter contracts rise with the prompt month. And LNG flows do not respond enough to close the gap. That is when companies start hedging aggressively and policymakers start talking about security of supply again. This is also where the EU's longer timeline matters. A plan to end Russian LNG by late 2026 and pipeline gas by 2027 forces procurement to compete globally. If the curve lifts, it is the market pricing that competition earlier and more expensively. Now, bring back our anchor example for the final time. The German chemicals plant starts this story dealing with a prompt price jump. If the curve stays calm, it treats the move like weather noise and manages quarter to quarter. If the curve lifts across summer and next winter, it stops being noise. The plant locks in higher costs, or it runs the risk of being caught short later. That changes output decisions, hiring decisions, and investment decisions. That is how a gas chart becomes a macro chart. Now, the clean recap and the three signals again. What happened is straightforward. Europe's gas storage has fallen to a weaker seasonal position than the market has been used to lately, and reporting put benchmark TTF around 42.60 per megawatt hour in late January, with analysis noting that pricing still looks less urgent than the 2022 panic curve. Why it happened is also straightforward. Lower buffer plus winter drawdowns pushes the marginal price higher, but urgency only becomes real shortage when the curve confirms that refilling will be difficult and expensive. Why it matters is that energy is one of the quickest links between the commodity tape and inflation, growth, and corporate margins. If this becomes persistent, it can spill into rates, FX, and credit through higher costs and a weaker growth impulse. And what to watch next is exactly three markers. First, the daily storage path on Gas Infrastructure Europe. Watch whether withdrawals stay elevated for a full week. That's your near-term buffer signal, with about a one-day lag. Second, the TTF futures curve, not the front month alone. Watch whether summer and next winter lift, with the prompt contract. That's your refill confidence signal, essentially same day. Third, LNG arrivals and send out into Europe. Watch whether higher prices pull in enough supply or whether the response is slow. That's your supply response signal, with a few days to a week of lag. That's the risk, and that's the recap. If you want the clean signal check, look at those three markers this week. I'll see you in the next one.